It was 3:47 a.m. GMT on January 8th when the number flashed across trading screens. 1.42 million. The Iranian rial had just crossed 1.4 million to the US dollar, marking the most severe currency collapse in modern Middle Eastern history. Within hours, a similar pressure began to build on currencies across the entire region. Traders were spotting a pattern, one that went far beyond national borders. What started as localized economic turbulence was rapidly revealing itself to be a systemic erosion of confidence in government-issued money, not just in Iran, but throughout the developing world. The collapse wasn't a slow burn. The rial lost 40% of its remaining value in just 72 hours. This was an acceleration of a decline that had been building since sanctions were resumed back in September 2025. But the pure math of this currency destruction tells a much deeper story. It's not just about failed policies or geopolitical tension. When a national currency loses 99.97% of its purchasing power within a single generation, the failure isn't just about economic management anymore. It points to a breakdown in the fundamental architecture of our monetary systems. At first, regional central banks brushed it off. They dismissed the Iranian situation as an isolated political crisis. This turned out to be a catastrophically wrong assessment. Currency traders, the ones with skin in the game, started identifying the same vulnerabilities across other emerging market economies. They saw central bank reserves being drained in futile attempts to prop up their currencies. They saw foreign debt obligations that were impossible to pay off with their export revenues. And they saw inflation rates that weren't just a temporary problem, but a sign of deep structural dysfunction. The contagion spread through channels most people didn't even see until it was too late. International trade deals that once used local currencies were suddenly defaulting to US dollar settlements as confidence simply evaporated. This caused import costs to spike overnight. Domestic purchasing power vanished, creating supply chain chaos that rippled from one country to the next through their interconnected manufacturing networks. The fallout was immediate. Turkey's lira plunged 15% in the week following the Iranian collapse. The Pakistani rupee fell 8%. The Nigerian naira dropped 12%. And this wasn't a coordinated attack by speculators. It was the market systematically recognizing a brutal truth. Fiat monetary systems operating under severe fiscal stress can and will fail with breathtaking speed once the mechanism of confidence is broken. The sheer velocity of the decline showed us just how much digital currency markets can amplify these traditional breakdowns. In the past, a currency crisis might unfold over months, even years. But today's financial infrastructure, with its algorithmic trading and instant capital flows, allows an entire monetary system to collapse in a matter of days. The destruction of the Iranian rial was a real-time demonstration of how quickly your life savings, your purchasing power, can simply vanish when electronic markets lose faith in a government's ability to manage its money. Central banks responded with the old, familiar playbook. They hiked interest rates. They intervened in foreign exchange markets. They imposed capital controls. But these tools were designed for an analog financial world, a world where information traveled slowly and trading happened during business hours. Today's currency markets never sleep. They operate 24/7, process information instantly, and execute trades faster than any policymaker can even draft a response. These old tools were completely inadequate for a digital age currency run. What made this collapse so dangerous was its demonstration effect. It was a wake-up call. Markets started looking at other vulnerable currencies with a new critical eye. They began pricing risk based on factors that had been mostly ignored during the years of easy money and global liquidity, things like fiscal deficit ratios, the adequacy of foreign reserves, and how dependent a country was on imports. Countries that looked financially stable just a week before were suddenly facing intense scrutiny about their monetary sustainability. The flight from these regional currencies accelerated, and it moved into physical assets with mathematical precision. In the week after the initial collapse, gold purchases in the affected regions soared by 340%. But it was silver that emerged as the preferred alternative, especially for smaller transactions and for preserving wealth over the medium term. This was particularly true among populations that had lived through hyperinflation before. They understood the critical importance of holding something portable, recognizable, and with real, tangible value. The market itself showed us why silver was the better choice in a crisis, far better than any theoretical analysis. Gold requires a larger investment, which excludes most everyday savers. But silver offered accessible denominations. People could gradually move their wealth out of a dying currency, one coin or one small bar at a time. Local dealers could also authenticate silver more easily and cheaply than gold, which reduced the risks for everyone in a chaotic environment. As a result, the premiums on physical silver exploded. Coins that were trading just 3 or 4% over the spot price in December were suddenly commanding 25 to 30% premiums by mid-January. This wasn't speculation. This was desperation. It was a mass hedging by millions of people watching their life savings get wiped out in real time. Governments tried to stop the capital flight. They put restrictions on buying precious metals, imposed foreign exchange controls, and placed limits on the banking sector. But these measures backfired. Instead of preventing the transition away from their currencies, they accelerated it. It was a clear signal to the public that the authorities themselves knew how severe the breakdown was, and that they were more interested in preserving the government than protecting the people's economic well-being. The ripple effects spread far beyond the initial regions, traveling through the interconnected global financial system. Multinational corporations with exposure to these collapsing currencies had to report immediate write-downs, which hit their stock prices in developed markets. Global supply chains that relied on manufacturing in those regions faced massive cost increases, forcing prices up for consumers everywhere. International banks that had lent money to these countries started bracing for defaults, not just on government debt, but on corporate and individual loans too. With local currencies becoming worthless, servicing dollar-denominated debt became impossible for many, sending shockwaves through global credit markets. But more fundamentally, this rapid succession of currency failures raised a serious question about the very viability of fiat monetary systems, systems that operate without any tangible backing, like gold or silver, and without credible fiscal discipline. The pattern suggested that any currency based purely on confidence can fail suddenly and completely when economic stress becomes too much for political authorities to handle. Investment institutions began a frantic reassessment of their portfolios. They were forced to consider currency risk factors that they had previously dismissed as negligible during the long decades of relative monetary stability. The shocking recognition that even major currencies could lose purchasing power so rapidly forced them to reconsider assets that hold their value independently of government policy. And from this analysis, physical metals emerged as the only asset class that couldn't be devalued by political whim, couldn't be inflated away by a central bank's printing press, and couldn't be defaulted on by a government. Silver, in particular, offered practical advantages for wealth preservation that even gold couldn't match, especially when it came to transaction flexibility and storage efficiency for middle-class savers. The Iranian rial collapse was the canary in the coal mine. It exposed the raw vulnerability of all government-issued currencies to a simple breakdown in confidence. It demonstrated just how fast modern financial technology can transmit that instability across the globe. What started as a regional currency failure was quickly turning into a much broader questioning of the entire fiat monetary system, a system that has operated on trust alone since the early 1970s. The big question that remains is whether this is just a temporary stress test for our existing monetary framework, or if we are witnessing the beginning of a systemic transition back toward asset-backed wealth preservation, a shift that could fundamentally alter the entire landscape of global finance. One thing is for certain. The speed at which these events are unfolding suggests we won't have to wait long for an answer, and it leaves very little time for anyone to gradually adapt to the new monetary realities. Thanks for watching. Don't forget to like, subscribe, and hit the notification bell to stay informed.